many cases, we as DeFi participants are probably not paid enough in yield on a lot of these things that we deposit into. And I think newer protocols are able to offset that risk a lot of times with token incentives. And that is a useful mechanism.
If that is our sole source of positive yield and outsized returns, that is not going to suit an inflow of another couple of hundred of billions of capital.
Everyone is sort of coalescing around like DeFi earning on stablecoins is the next thing. I'd say that was like a universal topic over the course of the week.
What are the variables that most people neglect if they see a vault or see a pool advertising very high APRs, and when the actual payout is going to be significantly below that? GM, and welcome back to the Odyssey podcast. Today we are joined by Ryan from Vaults.fyi, and Vaults.fyi is quite an important player in bringing a little more, let's say, transparency and integrity over to the yield farming landscape. I think everybody active in DeFi has had quite a few rather tough weeks ever since October 10th with the blow up of Stream Protocol and the consequential contagion that spilled over to a couple of Curators, to a couple of lending markets. So I think it is more important than ever to discuss how we actually bring some standardized data, a proper understanding of risk, and like an integrity preserving display of yields over to DeFi. So thanks a lot for joining us, Ryan. How are you doing?
I'm doing great. Today's my last day here in Buenos Aires. So been out here for DevConnect and some stuff beforehand, but yeah, doing well. Thanks for having me.
Very nice. We definitely have to get into your DevConnect takeaways later throughout the pod, but maybe let's start by giving a brief background about your persona and how the idea of Vaults.fyi came to be.
Sure. Yeah, so my name's Ryan, co-founder, CEO of Vaults.fyi. We actually started the company about 2.5 years ago doing something slightly different. We originally began kind of doing work for different DAOs, governance type stuff. And my background, my co-founder's background, most of our team's background comes from working at different DeFi protocols. So that's certainly what we're excited about and interested in. And within a few months of starting the company, we were trying to do this really simple thing, just build like get some analytics to see if there was any benefit to sort of constantly rebalancing between Aave, Compound, specifically on different chains. This is, 2023. So DeFi landscape was a little bit more limited at the time. And the
so
initial
you were
problem,
sort of the OG lending aggregator in some sense, kind of what a lot of the Morpho and Gauntlet vaults are doing now?
No. So, the longer backstory is we were thinking about doing something in that space maybe. And I actually stumbled across the fact that getting high quality, accurate on-chain data that would actually correspond to what a user earns was very difficult. And so the original version of Vaults.fyi set out to offer users more accurate on-chain APY data. And the way that we went about that was not relying on any external APIs to source that data. So if you look at an APY on Vaults.fyi today, what actually separates us from a lot of other dashboards and things like that is that we fetch all of the data ourselves. So the way that we compute APYs is simplistically just taking the share price of every product that we integrate. Today, that's thousands of vaults and yield-bearing stablecoins and pools, fetching the hourly share price, and then computing the change over time. So whether that's for the 1 hour average APY, the 1 day, 7 day, 30-day average APY. And so I always like to say, I think that we have the most accurate representation of APYs for all of the things that we integrate. And that's how we began. Since we've expanded, we do a lot more today, but that was really kind of the initial insight.
Yeah, funnily enough, a friend of mine who was one of the very few people in my personal friend circle who was also into DeFi farming, I think it was in late 2022, he pitched me a very similar idea because back then, throughout 2021 and leading up to the Luna collapse, you still had a very, let's say, Ponzi-esque and very degenerate touch to DeFi. Not that this has disappeared completely, but it definitely was another level back then. So you had a bunch of these triple digits, sometimes even 4 or 5 digit APYs being displayed. And it was very abstract to understand what actually went into this and what the bottom line APR was. I think in 2023, 2024, you had all of these automated LP positions coming on. I think it was on Trader Joe and like some of these LP management tools where you were able to constantly rebalance in UniV3 and concentrated liquidity pools. So you were able to display an absurdly high yield on your front end, but basically you were net negative because in most cases, impermanent loss ate away more of your principal capital than the yields could compensate for. So I still think that even now, there's a long, long way to go in bringing transparency to yields. It has changed a little bit over the last months, I would say. It is now less the kind of obfuscation of the APR itself, but it is more, okay, what is the APR being paid out in? Is it a reward token? Are there any lockups attached? If you are sometimes speculating on a points program or a points program is part of the advertised yield, like, is that excluded from the front end display? Is that included in like a valuation estimate? So I think there are still more than enough pitfalls to fall into. And I do think that Vaults.fyi is greatly contributing to making this space a little more transparent. So maybe do we want to walk through the application, or do you want to start by explaining a bit how you guys are sourcing the data, how you're processing it, and how the numbers displayed kind of come to be?
Yeah, sure. I could I could do both of those, but I guess, thanks for the nice words about Vaults.fyi. One of the challenges that, you know, I think is something we don't really have excellent coverage on today are things like points, because they are not, you can't verify in most cases what that will actually convert to in an APY on-chain data. So like today, we don't integrate products, for example, that only have points APY, just because that is very flimsy, right? It's not actually an APY that someone is guaranteed to earn in any way. AMMs and things with impermanent loss in that way are something we will eventually integrate. We kind of don't have those today. We've been very focused on what I would call like single asset or kind of like simple earn. So lending, yield aggregators, yield bearing stable coins, really anything in that bucket. And the reality is, and staking, liquid staking, the reality is that does make up the majority of DeFi TVL. And that's how most people interact with DeFi too. I do have a few friends who I've kind of onboarded over the last year, and a lot of them do, eventually find their way to Uniswap, and they look at the pools with the 200% APY or whatever it may be. And then we sort of have to, I mean, I at least have to kind of explain to them, yes, it does say 200%, but, you're competing against very sophisticated participants here. There's a chance that if you're not fast enough to move your position around, you could wind up with the pair asset that you don't necessarily want. And so, yeah, DeFi is still extremely complex, especially as you start getting into these things where, you can earn 50% plus, 100% plus, but there's just a lot of active management and corresponding risk that comes with those. Obviously, nothing is free in terms of risk.
What would you say
But yeah,
right now are kind of the biggest misconceptions about yields? Like, what are the variables that most people neglect if they see a vault or see a pool advertising very high APRs and when the actual payout is going to be significantly below that?
I'd say it probably has to do with one of two things, specific to the point of if they see a high APY and that's not corresponding to what they'll actually earn. I'd say the most common case is points. I think there are a lot of games you can play with points to, maybe the fine print says this is 100% APY, assuming a $5 billion day one valuation. And, in many cases, that's not going to be the case. So points are probably the number one thing where you can, I don't even want to say mislead, but really, really get people's hopes up of what they could possibly earn. The second bucket is probably an over reliance on current APY. So if you go to a lot of DeFi protocol front ends today, the APY that they will show you is the current APY, which often is reflective of the last block on Ethereum, Base, whatever network it is. Now, if you're borrowing, that may be very important. But even then, like there was an example from a few months ago where I believe Justin Sun withdrew a ton of tether from Aave's V3 USD pool on Ethereum. as a result of him withdrawing that tether, the utilization rate spiked. And for, I don't know, maybe an hour, the APY on that pool was like 40 or 50%. Previously, it was maybe 4% or something. After that hour, the APY barely changed over the course of the 1-day average, the 7-day average, the 30-day average, because so much money flooded into that pool to take advantage of that APY. And so it corrected itself very fast. And so you, as a lender in that pool, were maybe earning the equivalent of a 40% annualized APY for 1 hour. But if you were in that pool for 7 days, it maybe took your 7-day average APY from 4% to like 4.05%. It's just a blip, barely a difference in any way, shape, or form. So that's probably the other place where I think people can be confused about the APY.
I think very similar things happened once everybody started delevering and unwinding a bunch of positions over the past, let's say, 3 weeks, ever since the stream collapse became public. I think there were quite a few vaults and lending markets on Silo and Morpho that faced quite a few liquidity crunches. So yeah, maybe to start walking through the app, can you showcase a little bit what types of vaults you're looking at? Is there any restrictions in strategies you guys can cover, and how you assess the yields, and which metrics are the ones that make it count?
I'm happy to. So let me share my screen here. Great. So as you can see, this is our kind of flagship site. This is app.vaults.fyi. For anyone listening, our core business is actually a set of APIs that different wallets or funds or whoever can integrate to either access all of the data that we have or integrate DeFi Earn into their products. So for example, today, some of our customers are firms like Gauntlet, the risk managers and curators, where they use us for a lot of the historical data that we have. We also have customers like Kraken that use us to power DeFi experiences in their non-custodial wallet and some other stuff that we're building in partnership with them. So, but this is our site built entirely on those APIs as well. So just at a quick scroll here, you can see that we're sorted by highest TVL. Across networks, I think we have support for 17 or 18 EVM chains today. We've also just recently added support for Solana. That's available through our API, but not yet through our front end.
Will you add Monad?
We actually are not planning to add it yet. I know that they just went live today. We'll have to assess kind of what the DeFi landscape looks like there. But it's always a little bit easier if the protocols going live there are existing protocols that we integrate with. I think I did see that Morpho is live there, so that would be a good reason for us to integrate Monad.
Nice.
But yeah, just going through from an asset perspective, we support dozens, if not hundreds, of assets that people can choose to earn yield on. Maybe for the point, simplifying a bit here, I'll just sort by all USD assets. And let's say that we only want to see things that have a TVL of at least $10 million. And we're willing to check out any chain. As I was talking about earlier, we show APY in these ranges because we think that this is a more accurate way of showing what you as a lender in this pool will actually earn. So if I click on the 30-day average APY here, this is basically saying what has the APY been annualized over the last month. And this is probably the way to take a look at protocols that have the most sort of longevity to the APY. It's the most sticky, it's the most real. So now let's sort by highest APY. And yeah, you can see. So what have we got here? We've got some Midas products. We've got Aave Horizon RWA. Let's take a look at this one actually. So as you can see, this one is actually mostly token incentives. So assuming you guys can see this here, the base APY is 1.4%. Token APY is about 12%. If I come up here to settings, I can actually turn off these token rewards as well. But for the purpose of here, I'll leave those on because I'm happy with token incentives in many cases. And yeah, what's a good one to click on? Let's go with this Aave Horizon Vault. So let's take a look at the last 30 days of data. And as you can see here, so this has been pretty sticky. It's had a very high rewards APY. Basically since it launched, so back through September, token rewards on this have been almost 10%. you can see that the rewards token is actually just more of Aave Horizon RWA RLUSD. Bit of a mouthful to say. But yeah, we break all of this out, fetching all of this data directly from on-chain. And sometimes with rewards contracts that will come from Merkle, if you're familiar with that tool for sort of rewards distribution. So we do have to integrate that as sort of the one external API that we use. And then, yeah, we've got the full historical data. We've got some
On the
description
note
of
of
where the,
rewards
yeah, please.
distributions, are you dependent on the data that Merkle provides, or are you able to also double check on the blockchain itself whether the rewards that are advertised are actually being paid out and in which time frame?
That's a good question. Merkle is the one case where we do have to use an external API. So we don't have that same sort of on-chain verification where we're just pulling data directly from RPC providers. I'm not aware of any particular issues we've run into as a result of that. And I'll actually show you on our dashboard tab kind of what else we do to integrate that. But just to kind of wrap this up real quick. So we've got some description of where the yield comes from. Of course, a breakdown of what the rewards token actually is. We're working on some very early risk scoring stuff, and maybe we can come back to that as a longer topic of conversation. So I'll gloss over that, and then ownership distribution as well. So for holders, and then yeah. So let me come back here actually, and let's just go to base and take a look at USDC opportunities here. Do the same thing, same kind of filters. And let's actually deposit into one of these pools. So as you can see from this little green dot here, uh, I've already got some active positions in some of these protocols. But let's come around to Tokamak here. So as you can see, Tokamak's yield moves around a lot. We're able to chronicle that whole thing. And yep, you can see here a bunch of this detail. Yeah, let's go to Gauntlet actually. This is another good example. Great. Now, as you can see, we actually take the stance on our front end of we don't charge any additional fees, nor do we add any sort of additional risk or smart contracts or wrappers in between the users and the protocols that they're interacting with.
Hmm,
So I think you won't be able to see my Rabby wallet, but the simulation that's popping up here is exactly identical to what you would see if you went to Era's website directly, and the same is true of Morpho, Aave, all of those.
nice.
So now I've actually made a deposit directly through our site. And then you can see everything that we do today around position tracking as well. So I'll take a breather there just to see if you have anything you want to jump in on.
That's pretty cool. So the positions displayed on the dashboard that are only the vaults that are covered on Vaults.fyi, right? It is not a separate portfolio analytics tool.
Correct. So once we integrate a protocol, and today I think we have about 70 or 75 integrated, then users also have this level of position tracking. But for example, if there was a protocol that we didn't integrate, we're not going to have position tracking for that.
Hmm. If we move down the risk curve a bit, into some of these gray box stable coins and gray box vaults that have been around at least until a few weeks ago, were these listed at all on Vaults.fyi? And if they were listed, how would you verify the APY and the sources of the yield for these types of vaults?
Yeah, so I mean, verifying the APY is somewhat programmatic on our side, right? We're just fetching the share price every hour and then automatically computing what that looks like. So even for, and just for the record, we did not integrate with Stream or Elixir or, um, yeah, really those two.
Right.
So had we integrated them though, I think the APY that we would have shown would have probably been close. Like in each of those cases, they did have actual real APYs. The challenge though was all of the underlying structure and sort of looping that was going on non-transparently between a bunch of these things.
Hmm. So when you're assessing the APY, are you basically looking at the total value of the entire vault adjusted for TVL and like inflows and outflows over time? Or is it the market price of whatever receipt token or liquid wrapper you receive when depositing into any given vault?
Um, yeah, so we of course do have the TVL data as well, and you know it will depend a bit on the protocol, but in a very sort of oversimplified perspective, the two ways that a lot of protocols work are you have kind of the classic compound Aave model where yield or the LP shares basically increase linearly over time as borrow and interest is paid back to the pool. So we are able to just, all of the APY data though comes from the share price ultimately.
Mm.
So of course that sort of takes into account the changes in TVL, but from the computations that we're doing, it's really just from the share price is giving you the accurate information.
Okay.
The other way that a lot of protocols work though is that especially with kind of newer protocols that are a little bit more fund-like, so say a Midas or an Upshift or Vita, they rely on the manager actually making updates to the share price. So let's actually just, if you want, I can go show you an example of what that looks like.
Yeah, I think especially for the synthetic stables, that would be pretty interesting because they usually have like one, I don't want to accuse them of like an intransparent leg, but like one centralized leg, which we cannot see on chain. So the APY and like the verifiable yields are dependent on the payouts that they are accruing on whatever other leg that is sitting on often centralized exchanges as well.
Correct. So let's see if I can find an easy example here. Okay, here's a perfect example, right? So this is the Upshift Edge USDC vault. And as you can see, let's go to the 1-day average APY, right? So obviously this looks crazy, but this is not actually an error because what this is saying in a somewhat literal sense is that in this period just between so TVL picks up here. In this period between like September 27th and October 22nd, there wasn't updates made to the share price. And so if you were in this vault and you had deposited and withdrawn in that time frame where it's zero, you've actually earned nothing because the share price has not changed in that period of time. Now, you can see here the manager makes this sort of enormous update. And so what this is literally saying is that if you had been here for this 24-hour period, this is actually the APY that you've earned. Now, if we look at the 30-day, you can see it smooths out a bit more to correspond into something like, okay, the 30-day in this is actually about 17% or so. So it can be a little bit tricky, but the way that these more managed vaults work, this is actually kind of the math that you have to understand when you're getting into one of these products.
So these very discrete outlier events, especially connected to manual updates, that can obviously also skew the 30-day average of an APR by quite a bit, as we've seen
Absolutely.
in this particular vault. So is there any methods to kind of adjust for volatility in the APR, or where you can showcase, well, this is actually a manually paid out or manually updated vault, so the averaged out APR might not be indicative of future returns or kind of normal returns?
Yeah, so I think that things like the 30-day average APY do already give a good perspective into what that actually looks like as compared to, say, current APYs or some front ends, which may show something like a target APY, which is more just like a manager sort of indicating what they hope to earn.
Right.
But yeah, I think there is still a lot more we can do on this. And I think especially the events of the last month or so, we've just had a lot more requests for things around risk, for things around transparency, collateral backing. And so, even just making this distinction between linearly gaining vaults and sort of manager updated vaults is certainly something that we should probably do.
Yeah. Maybe just to transfer over to that block of topics, how has building Vaults.fyi shaped your personal perspective on yields and like yields in contrast to the risks you're taking, and how has it shaped your thinking about risks in DeFi?
Mm. Perhaps one perspective there is that in many cases, we as DeFi participants are probably not paid enough uh, in yield on a lot of these things that we deposit into. And I think newer protocols are able to offset that risk a lot of times with token incentives. And that is a useful mechanism. But getting to then that sort of steady state of either your Aave and you have basically the highest amount of trust possible in the market, or you have a uh, base APY that is compensating over Aave's yield by say 2, 3, 4, 5%. Most protocols don't get to that place. So here, let's actually do another example. Let's do just USDC and USDT, so the biggest assets in the market, and I'll do all these USDT derivative things too. Great. And now let's go by 30-day average APY, and let's turn off token incentives and sort by that. So, okay, of course, we're going to have some outliers. Actually, put a TVL filter on because that cleans it up a bit too. Great. Yeah, so now as you can see, the things that are outperforming are some of these vaults that either have had some exposure to the stream Elixir type of stuff. So the
Yeah, I
APYs
think
are
one of
just
the
from,
before you put the TVL filter on, I recognized quite a few of these names who came up in the discussions on Twitter about having stream exposure. I don't know if this is the particular one by Varlamore, but I think that either this one or another one on Silo had stream exposure. And yeah, one of the, I think it was one by the MEV, the Frontier one.
yep,
I recognize that. I'm not 100% sure, but some of these names do sound familiar.
yep. Yeah, so I mean, a lot of these Euler, I forget the total number, but I think across, inclusive of Euler and Morpho, the total exposure worked out to about 250 million or something like that. Is that, I don't know if you remember the number yourself, but
Not exactly. I remember that Yields and More, they put out a post that was quite comprehensive about the different exposures.
yep. Yep. Yeah, but just kind of coming back to the initial item there. So, as you can see, I think like going through a lot of these, they are either these much more managed strategies. So like these Midas pools, for example, really what these are doing are, a manager is sort of loosely outlining a strategy, but you're really giving a lot of discretion to them to sort of execute on something and deliver an APY against that. So you're seeing a lot more of these get popular. Of course, yield aggregators like Yo. And then as we come over here to say like some of these steakhouse vaults and stuff, some of these gauntlet vaults, the higher performing vaults on Morpho, I would say these base APYs do outperform like what I would expect to get from an Aave in a kind of proper risk adjusted manner. So there are some products that I think are doing a good job here.
So over the past months, we've seen a bunch of cross collateralization coming up to frame it that way. It's not necessarily an under collateralization. So I think the people, especially on CT, who drew parallels to the Terra Luna era, I think that's an improper comparison. But we do see a lot of vaults depositing into other vaults. So it's very hard from a user's perspective, if you're just glancing over dozens of different yield opportunities, to always stay on track what these funds and vaults actually have exposure to. Many of them are kind of backing another. So, in terms of risk metrics, is there any standardized scoring system you have been able to come up with? Or if you're in the process of developing one, how are you thinking about risks and like what are the variables that actually matter? Because I think that it is very easy to like come up with some vibe-based risk metrics. I also know that from conversations with other people who are very active in DeFi. It's like, oh yeah, I met the team once and they seem smart, so it must be low risk. Or I don't like their website, so it must be high risk. Or like their name sounds silly, so it must be like there is no quantitative and no reputable and no standardized way of assessing risk right now in DeFi. And I think that is a huge variable and a huge problem to solve for. So would be very curious to hear your thoughts on that.
Yeah, I basically agree with what you've just said. I think there is no silver bullet. And if there was, I think someone would have done it a long time ago. You know, we released a V called a V1, maybe a V0 of something thinking about risk. But we really approached it as like a Lindy score or kind of a reputation score, where the biggest inputs were TVL over time in the vault, in the pool, things like that. And so when you use a framework like that, as we did, the things that wind up being the highest kind of risk adjusted are Lido staked ETH Aave's biggest pools on mainnet, and that makes sense, right? Like those are products where, like in my mind, if Lido got hacked, we'd probably, I don't know, freeze and roll back the chain or something, right?
Yeah.
It would be so existential to Ethereum that it is sort of enshrined and very safe in that respect. I'd say Aave's biggest pools on Ethereum, again, vibes based, it sort of sanity checks out for me. I think where things now get very tough is we support 75 protocols today. Whenever a new Euler or Morpho vault gets deployed, generally speaking, we start indexing it once it crosses 100K in TVL. And so there is now another level of risk to a lot of these curated and managed vaults that it's almost impossible for any one provider to think about integrating all of that.
Mm.
I also think there's a second piece, which is that I don't know that risk scoring in crypto is historically a good business. And so I think unless it's sort of bundled into something else, people who have tried doing this in the past have really kind of failed to monetize or
Yeah.
have not been able to monetize.
I mean, the only path to monetization that I could imagine is that you have a model where you have sort of a, let's say, credibly neutral association of a bunch of large stakeholders in DeFi on the farming side, on the builder side, protocol side, foundation side, etc. They agree on more or less objective and standardized risk scoring, and then newly launched protocols kind of have an incentive to pay them to get like this accreditation and risk scoring attached to their website or whatever. But yeah, I fully agree. It is hard to monetize it.
Yeah, well, even then, I think when it comes to risk, there's so many different types of risk as well. So there's another group. They're called, I think, DeFi Collective. I know they were trying to do kind of like a risk scoring type of thing. They've done it for a few DeFi protocols to date, but they've really focused on like centralization and governance risk, which, just for the record, is not something we've even like once thought about when we think about risk. Of course, it is a risk. It's just we've thought more about, say, collateral backing or how much discretion does the manager have to move the funds. And in the case of
Would
like a
you say
Midas or
that
an upshift, yeah, that's very different than governance risk.
would you say that governance risk has ever played an actual role? Like, I think from
Hmm.
just anecdotally from what I've seen, what I personally had exposure to, etc., it's mostly something goes wrong on the collateral side, and
Yeah.
only then it unwinds whether there's like some kind of under the table agreement between two protocols, like the whole stream versus elixir situation with like redemption rights, etc. Like
Yeah.
there is no way to know of these things up front. So like, does it even make sense to put a lot of weight on these governance risks? And in contrast, if you have like a textbook decentralized DeFi protocol where everything is transparent, are you even able to generate abnormal yields to the upside compared to what is the market rate?
Right. Right. I agree. I agree. So I think that is the different thing. And we didn't even talk about, for example, smart contract risks and auditor risks. And, so there's so many elements to thinking about this stuff. And I think the reality is, I don't know, let's think of one of the recent examples, like Compound, I think was such a tricky example recently where they had some bad debt as a result of accepting Elixir or DEUSD as a collateral asset, if I'm getting that correct. I don't know. Like for me, I don't know that that's something like that's so complex to have even caught in the first place, like proactively. I think Compound is previously, at least for most people, would have been closer to the Aave tier of like, of course, Compound's never going to have bad debt. So yeah, there's just a lot of these. And I think intertwine or sort of untangling that web on the collateral backing and risk side is its own thing. We are talking to a few other like big DeFi companies and risk providers today about some consortium type thing. But I think the reality is that we'll wind up piecing together risk analysis from a bunch of different places. Like, for example, just doing risk monitoring on Morpho and Euler collateral markets is probably a full-time job. And then doing that for, say, Midas, Upshift, these vaults that are more like managed fund strategies is also a completely different thing that you'll be looking at. So there's not a lot of overlap even in looking at like Euler underlying backing and say Midas underlying backing. They're just so fundamentally different.
Uh, I mean, I can say for me as a, I would say fairly active DeFi user, it is very difficult and almost random to assess risks. I have no technical ability. I do not have a data analytics background, so I cannot perform any of these analyses myself. Pretty much the only thing I can rely on is like these vibe-based metrics, whether like friends of mine are in there, whether I know the
Yeah,
team, etc. Like you can have quantitative proxies like the resilience of a TVL if you understand the collateral backing a bit. But I mean, if it comes to something like Stream, and for example, I knew 0x Law personally, and I think he's a very smart guy, and like it's obviously still a developing story who's actually at fault there. But if you even if you looked at the Stream wallets, and of course that was not like the entirety of their funds that was transparent on chain, it is a full-time job to just really understand what they are doing there. If you're looking at basic and popular tools, like which are good, like dbank, you can see kind of what they are doing, but you still have to interpret occasionally what the actual strategy behind this is. Like it is not always that obvious. Like it starts with all the looping, cross collateralization. Like it is very hard
right.
to kind of display a causal chain that gives you insights into the flow of funds of any different wallets, like the complexity and kind of the money Lego aspects of different strategies and wallet transactions. It is very hard to kind of stay on track with that. And now if you have a dozen wallets that you're following, it basically turns it into a full-time job for you.
Correct. And I think also anyone who's kind of in that market of risk, it's just, I don't know, you could say, okay, this is a risky strategy where they've taken funds, they've looped it 3 times, it's across 3 different networks. They're borrowing on one chain to deposit on another chain. I don't know how to sort of package that into an easy thing other than just saying like, hey, this is risky. I mean, that's kind of what it comes down to. But yeah, I mean, the way that we're thinking about this is we want to integrate what other people are doing. So, for example, Redstone just acquired a company, Credora, that used to do asset ratings. We've integrated their stuff when they were a standalone company, Credora. As Redstone sort of makes more of that risk scoring stuff available, we're going to integrate that as well. So as people, release new frameworks, please get in touch with us. We're always happy to, try and get closer to figuring out what a risk adjusted yield actually is.
Hmm. When you're adding new protocols and new vaults, are you trying to reach out to the vault curators and get a better understanding also on a qualitative level of what they are doing and kind of derive a risk assessment there? Or are you kind of limited by quantitative data that you can actually find on chain?
Yeah, we're not making any qualitative assessments today.
Hmm.
I think probably the most qualitative assessment you'll see on our site is just like some of our tags that we tag different vaults with. I mean, even then, those are not us really having much of a strong opinion on any of this.
Would you say that working on Vaults.fyi and like being in the kind of trying to get down to the like real part of DeFi, has it shaped your personal perception of risk and like your opinion on various vault curators, vault infra, and strategies? Like, is there anything, for example, that you would say a lot of people have exposure to, which you would never touch with a 10 feet pole, and which you think is absolutely not worth the rewards given the risks? And like also on the other side, is there something which you would say like this is almost overcompensating people?
Hmm. Interesting question. I don't know that anything jumps out to me as like something with $100 million plus of TVL today, where I think it's, you know, inherently very dangerous or risky. I think, I was just looking, I'll say this. So today, a protocol like Wildcat, for example, that does uncollateralized lending, we have integrated their data into our sites. At the same time, we don't make it available on our front end today. And I think that's one where I have just felt like there's too much qualitativeness for
Mm.
us to kind of choose, okay, we can make this available, we can't make this available. Because I don't know, lending, again, vibes based, but lending to Wintermute at 12% seems pretty safe. Like, I think, whatever CT says, Wintermute's
Haven't
probably,
you seen the rumors that Wintermute has blown up on October 10th? Like
I
they are
was
the
going to
ones
say,
who are selling the coins, man.
whatever CT says, I think we're
They
pretty
must
safe
have blown up.
that Wintermute is a pretty safe bet. And like, lending to them at 12% is probably an okay thing to do. I think that's fair to say. But at the same time, I'm just basing that on my vibes. Like,
Yeah.
I've met the Wintermute team before. I think they're trustworthy. I used to work on an uncollateralized lending protocol. We lent hundreds of millions of dollars to Wintermute. They never had an issue. Blah 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 blah. Um, at the same time, there's other products there where it's like, okay, I these things will always be very high because they have like a 16% APY. I don't know that it's inherently kind of correct to show them. And I think really the events of the last month have maybe made us a bit more cautious in some of the things that we add. I mean, obviously our site, do your own research, read the terms of service, you're interacting with other protocols, etc. No matter what we do though, like people always say, well, you integrated this thing. I think it's, safe as a result of that, blah, 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 blah. So I don't know. Like, listen, back to the point of risk, if someone had a silver bullet, we'd love to integrate it. I just don't think it's there.
On the note of under-collateralized loans, do you have an opinion on FreeJane? I think they just launched their like initial deposit vault a week or two ago.
I'll have to take a look. I mean, I think because they're doing basically consumer kind of credit, right? Yeah. I
I
mean,
do think so. Yeah.
I think that's just like the toughest market on earth.
Yeah.
So I chatted with their founder before. I mean, I wish them all the best. I just think that's such a challenging piece of the market. There's also another very popular app on World. It's just called Credit. I think their URL might be like credit.cash or something. They are also doing sort of uncollateralized microloans with maybe like some social proof element to it. I think they've had a pretty good repayment rate so far, but still, like the default rate obviously is not zero, and you just have to be able to charge people high enough so that those defaults are offset in the grand scheme. But very, very challenging piece of the market to underwrite for sure.
How do you view the risks of cap.money? I think that's an interesting one because there the risk reward changes a lot depending on which stakeholder you're looking at. I mean, the CUSD holders are doing pretty well because as of now, it is still like not at a scale that would be existential to the entire restaking system or like it would be actually under collateralized. I think the people who are borrowing are also doing pretty well, but like the entire pool of these, I think it's 15 or 17 billion of restake capital, which is still kind of just like sitting there. It is one of the weirdest capital allocation dynamics in DeFi. Back a year and a half ago, it was the hot thing. Everybody like farmed all of these restaking protocols, me included. But still such a huge amount of capital. And I mean, 17 billion, it's not nothing for DeFi standards. That's quite a big chunk. It's still sitting there. And nobody really cares about the bottom line yields. And yeah, you can obviously tap into that and it's a huge pool of capital. So like as a protocol, you have a strong incentive to use it to overcome initial liquidity constraints. So do you have any opinion on that particular project?
Uh, I don't have a super strong opinion. I think that the sort of, I forget the precise term they use, but the allocator type of model is interesting. I recall that a lot of their, in some of their early announcements, they mentioned some of the people that I think would be sort of managing those funds. I think today, like obviously they're still in a bootstrapping phase, so it's been a lot of smaller managers. I think that, I think I could take a look at their transparency page, right? But like I think Susquehanna is maybe one of their investors. I would love to put money in something that like where Susquehanna is managing the funds. And I actually think that kind of gets to a broader DeFi type of thing in the curator market today, which is that everyone curating pools today is DeFi native, right? The Mevs, RE7s, Steakhouses, Gauntlets of the world. And I'm very curious to see if we get more traditional type of managers or credit funds or whoever coming on and actually starting to allocate capital on some of these protocols like Morpho and Euler
Hmm.
or Cap or Silo or wherever. And I'm curious then how that sort of changes the landscape of what type of APYs people are willing to accept. So that's actually one of the broader trends I'm interested in. Maybe Cap will be one of the first places that some of these people do sort of accept those funds essentially. But yeah, we're certainly in a very transformative time in DeFi.
Yeah, I think that Cap is definitely one of the interesting players out there. We also had Dave, DeFi Dave, on the pod throughout summer. I think Free Jane is another one, which I personally really like. It's like, of course, there's no precedent case of it really working well, but I think if they are able to unlock individual credit lines, may it be for consumption or whatever else, I mean, that would make DeFi so much more accessible and actually so much more useful for normal people. Because as of right now, 99% of what DeFi is just a bunch of autistic men between their 20s and 40s playing around with like more or less Ponzi-esque games and like kind of forming each other. But the connection and the utility of DeFi into the real world is still quite limited. And I think making under-collateralized loans and yeah, just capital efficiency. Also, the whole neo-banking trend with the EtherFi cash card, with what Mantle is doing. I think that is a very healthy development. And like, we're actually getting to a stage where we can make a case for what we are doing as an industry, provide some utility to everyday life.
I hope so. I hope so. Well, we'll see. I would recommend checking out the credit app on World. I think that they're actually pretty far along in sort of these micro loans for more. I think Argentina is their main market today, but
Is
they've
that connected
done,
to WorldCoin or where is it on?
yeah, so it lives on World Network today.
Nice. Do
Yeah,
you
but
have to scan your eyeball to use that, or can you use it without?
to use credit, I believe you have to do proof of humanness. Yeah,
Okay. So you scanned your eyeballs.
I have, yes.
Nice. Maybe to pivot to your takeaways from Buenos Aires, I've seen there was a Vaults summit going on and like a bunch of like curation and DeFi centric side events, which personally I very much appreciate. I still remember DEF CON from 3 years ago in Bogota, where you had like Yearn Finance and like all the DeFi things that were relevant back then in the Ethereum ecosystem, but it was still very techy, very developer focused. And for like the economics and finance people who were more native to DeFi, it was kind of a limited surface area of side events that were interesting. So what were your takeaways? How was the sentiment, and how is everybody looking at the Vault ecosystem right now?
I would say that DeFi earn generally was like the topic. I mean, maybe it was just the rooms that I was in. It probably was the rooms that I was in. But across the board, I think that was what everyone was thinking about. And everyone is trying to figure out either how they can integrate DeFi Earn, whether Aave, Morpho, Euler, Compound, whatever, into their product in some way, shape, or form, or they're thinking about how to sort of capitalize on what's going on in and around that market. And one of the questions I heard from someone before this conference was, it was someone who works kind of in the stablecoin space. They talk to a lot of companies that are thinking about integrating stablecoins. And the question they get from some of these fintechs and neobanks is, okay, we've integrated stablecoins into our product. What do we do now? And I think everyone is sort of coalescing around like DeFi earning on stablecoins is the next thing. And so, yeah, I'd say that was like a universal topic over the course of the week. I think also there is a lot more thinking going around the fact of, so I moderated a panel at a Vaults Summit as well on the topic of curators. And one of the questions I asked, just like a really simple kind of question to get the panel started, was, what does the word curator even mean? And then I had the same question for like, what does the word vault even mean? You know, when we named our product Vaults.fyi, it was just like a nerdy little head nod to the 4626 tokenized, vault standard. I think vaults, though, have taken on a life of their own to mean this kind of catch-all term that can mean almost anything, but as a result, kind of means nothing. And the same is kind of true, I think, or it's becoming true for the term curator as well. Because there's some curators that act much more like, hey, we're picking a few conservative markets to deliver an APY a few points above the risk-free rate. And then there's people who treat vaults and their role as a curator more as like a very discretionary, risky hedge fund manager. So both of those terms, I think, have gotten a bit bastardized. And, definitionally is something I think a lot of people are thinking about, how to add more precision to what these things actually mean.
So what is a curator?
It's a great question. I think the original longer form that's just been shortened to curator was really a risk curator, right? It's, if you think about the role that a gauntlet used to play at Aave, and I guess still plays at Compound today, they're the risk manager at these places where they're analyzing different collateral types. They're looking at the liquidity, if they have to liquidate assets, right? It's really a risk first type of mindset. With curators, I do think folks like Gauntlet, just as a simple example, have been quite risk minded still in terms of, we're doing these deep analyses, and Stakehouse does the same thing. They publish these very long reports on everything that they accept as collateral, right? It's a very risk first mindset. I think though a lot of other curators have treated it maybe as more of like a, I don't know, like degen maximization upside in terms of like, let's, try to offer the highest APY possible on a lot of these things. So yeah, I don't know. The term, it kind of means many things at this point.
Well, I think the incentives are that way, that you have to optimize as a curator and as a vault one for TVL. I talked at length about this with Vlad from Tau Labs,
Hmm.
because they're also doing a lot of looping strategies, but they, together with IPOR, where they are
Yeah.
hosting most of their strats, they opted for a way where it actually differentiates between the total value managed and the, like, what are the user inflows, and kind of looped up what is the sort of surface amount of TVL. And I think that's a very, very good step. And yeah, I mean, of course, you're competing still over a rather limited pool of DeFi native capital. So you have a very strong incentive to crank up the APRs as much as possible and to go down the risk curve. I mean, frankly, if you are a lending aggregator and you're sitting at 4%, 5%, 6%, why would anybody with size allocate into that? Like, you
Yeah.
can get
Correct.
US Treasuries for 4%, where you have like much easier flows back into real world expenses and like TradFi connectivity. I mean, the only reason why you would participate for like single digit yields in DeFi is that you're outside the US or you're inside the US, and like you value financial privacy, and like give that a risk premium, and consequently also take in a considerably lower return given your additional risks. But for the like normie user, and I mean, most of the capital is allocated by very conservative money managers, and a lot of this capital is related to retirement funds, pension funds, etc. So they have to optimize for lower risks. I still think that, yeah, there's a long way to go before DeFi can match that and
Yeah.
appeal to them.
Yeah, absolutely. Yeah, and we actually we don't have it available for transactions yet, but we do have IPOR as well. And as you can see, a lot of these vaults that were doing looping or looping type strategies, like this levered SUSDF one, I mean, these actually have just been negative. And I think that is something that, at least with DeFi of maybe like the DeFi that I grew up on, the idea of a negative yield on a DeFi vault was kind of like, I mean, how does that happen unless something gets hacked? But now as you do have these levered looping strategies, these strategies can get broken, and you can actually lose funds in some of these.
Now, what I find a really interesting metric is that you're displaying the number of holders on your side. I think this
Yes.
is so. I mean, everybody jokes about, yeah, DeFi is always the same, like 5,000 to 10,000 people who are transacting on all of this stuff. But analyzing the holders actually proves this to be right. Like, it's a very, very small world on chain, and yeah, we're kind of all chasing the same points and asymmetric yields. And I do think that if you're looking into the future of DeFi, people, of course, we want to have institutional adoptions and we want to have normie capital flowing in. But I mean, capital at the end of the day is the enemy of return. Yields will get diluted. I think we have to acknowledge that most asymmetric yields to the upside in DeFi are still subsidized by points. And then that kind of trickles down the risk ladder, through Pendle PTs, looping these things up, vaults allocating into them. Then if you want to crank up the yield a bit, you can obviously add duration to that. That is what Infinify is doing.
Yep.
And but like, if the kind of points speculation collapses, there is no like asymmetric positive source of yield in DeFi right now. And I think we desperately need to figure out how to make this more sustainable, because I mean, there's always going to be some appetite in speculating on new protocol tokens, which these points will hopefully convert into. But if that is our sole source of positive yield and outsized returns, that is not going to suit an inflow of another couple of hundred of billions of capital. That's just
Mhm.
not going to sustain.
Yeah, absolutely. Absolutely the case. I think a
Nice.
lot of people would say also that RWA collateral is potentially a solve for some of that. I remain optimistic, but I need to kind of see it actually start to happen in a more meaningful way.
Yeah.
It's been pretty limited in scope so far
Yeah.
and pretty
I think
isolated.
on the whole RWA and like integrating fintechs and fintechs integrating DeFi, another variable is that it is to be decided how much of the value created by that is actually going to end up in our hands versus is going to end up in the hands of these fintech companies. Because like
Mm.
they don't have an incentive to like share revenue with token holders. Many of them don't even have an incentive to launch a token at all. Like if they can tap into the technology that is going to save them money or otherwise make them more money or maybe even both, like why would they share any of that with like, I don't know, degen yield farmer 68 on CT? Like there's no incentive to do so. So yeah, I think the existential fear of our very DeFi native industry getting replaced, I think that we cannot completely neglect that. So while I do think that we have established quite a few resilient and like proven primitives, there is no guarantee that the industry will flourish in of itself going forward. And there is a risk that all the technology is just going to get integrated by TradFi and fintech players who are much better at the distribution and growth game than what DeFi people are.
Yeah, I mean, I think that there's maybe two ways to think about that. One is the complexity of DeFi is still quite high, and you can think about sort of what like a neobank integrating a few DeFi products is doing. Is they're playing some sort of curator role for their users. They're almost giving the stamp of approval to their users to say, "Hey, we've integrated these two Aave pools, this Morpho Vault, this Euler Vault. Like these are things that we think for you, user, are kind of safe to interact with." But it definitely puts DeFi as a back end technology, right? It's the whole DeFi mullet kind of concept. And I mean, that's what we're pursuing with our API strategy as well, right? We're trying to make it very easy to enable these firms to integrate DeFi with a very Web2 feeling API, but where we abstract away all of the complexity of interacting with these different protocols from one place. I mean, we're certainly taking a big bet that that actually is the future. I don't think that that totally, removes the value prop or ability for us to directly interact on chain and make money from these things. I do think there's open questions about like the sustainability of DeFi protocol business models, but perhaps conversation for another day.
No. Well, it's great having you on. We're about to hit the hour, and I think, yeah, you've shared a bunch of insights, and this really helps to better understand and categorize risks in DeFi and in allocating into vaults. And I think it does make sense in some cases to use vaults and vault curators instead of doing everything manually. At least for myself, I've found that to be a decent way to manage my DeFi portfolio. I've been using Vaults.fyi for quite a bit of time. Sometimes it's a little disappointing to see the bottom line of the actual yield versus what is being advertised on some other front ends. So yeah, there's two sides to that, and there's two sides to knowing how much yield is actually generated by all of this. But yeah, thanks a ton for coming on, Ryan. Maybe if you have any last words or last advice for people, if you want to shill people a vault that you particularly like right now that is listed on Vaults.fyi, feel free to do so. And also let us know any links or any websites that people should check out and how they can get in touch.
I hope we don't disappoint you too much by showing you the correct APYs for a lot of these things. But it's kind of like the Matrix red pill, blue pill. You can take the blue pill, continue to look at protocol front ends, go back to bed and pretend it's all okay. Or, you can look at our site and take the red pill, get a better sense of what you're actually earning on these different products. No, nothing for me really to show today. Check out Vaults.fyi. Obviously, we integrate a lot of things in there, so please do your own research. If you want to follow me or us, my handle on Twitter and really everywhere is just my full name, Ryan Rodenbaugh. And then our company is at Vaults.fyi, FYI on Twitter. And if you'd like to use our APIs to either access accurate on-chain data or integrate DeFi into your product, please shoot me a message and we'd love to get you set up.
Very nice. Thanks a ton for joining, Ryan, and we'll make sure to link all the links in the podcast description.
Awesome. Thanks for having me.
Have a good one.
You too.